Welcome to the Explainer. All right, picture this. You're a junior auditor, you've got your coffee, and you're stepping onto the site of your very first big client engagement. You've spent hours learning the accounting rules, you know exactly how a balance sheet is supposed to look, but now you actually have to prove that the numbers the client handed you are, well, real. How on earth do you do that without manually checking every single receipt and transaction? Well, you evaluate their systems. Today, we're tearing into Chapter 8 of the Audit and Assurance syllabus, Systems and Controls. Let's get to work.
So here's a really serious question to start us off. Why do genuinely good companies still produce bad financial statements? I mean, sure, sometimes it's outright fraud, but honestly, a lot of the time, it's just a complete breakdown in their internal processes. You can think of a company's internal controls a lot like its immune system. A healthy immune system is designed to prevent, detect, and correct errors. Think of those as the infections, before they blow up and cause a material misstatement in the financial reports. But if that immune system is compromised or weak, the risk of bad numbers slipping through just skyrockets.
Here's our roadmap for today. We'll start by demystifying internal controls, look at the system's inevitable limitations, dive into ascertaining and documenting those systems, move on to testing the controls, and finally wrap it all up with some real-world audit application.
All right, Part 1. Demystifying internal controls.
Okay, let's set the foundation here. This workflow is basically the holy grail for an auditor's mental map on this topic. It's exactly how it works in the field. Notice how the whole process flows downward. We start high level, right? Understanding the client's overarching systems. From there, we zoom in to evaluate the internal control components and the specific control activities to see how they're supposedly operating. Once we've got a handle on that, we move down into actually testing those controls. And finally, we wrap up by communicating any deficiencies we found back to management. Lock this sequence into your brain. It is literally the exact step-by-step you'll use on the job.
Now, listen up, because this right here is a classic pitfall for ACCA and degree students. You absolutely have to nail the difference between a control objective and a control procedure. Here's the bottom line. The control objective is the actual risk you are trying to manage. Think of it like, what if an employee buys a top-of-the-line laptop for personal use, but sneaky charges it to the company account? That's the risk. The control procedure, or the control activity, is the physical action taken to stop that from ever happening, like, say, requiring a senior manager's physical authorization signature on all purchase orders. The objective is the why, and the procedure is the how.
So, once we know what procedures the client has in place, we have to figure out how to audit them. And guys, there is a massive difference between tests of controls and substantive procedures. A test of control evaluates the mechanism itself. Remember our immune system analogy? It's checking to see if that immune system is actively working to prevent errors. Substantive procedures, on the other hand, like tests of detail, those are looking for actual hard material misstatements at the assertion level in the financials. Think of it like this. It's the difference between testing the metal detector at an airport to make sure it beeps versus manually opening and searching every single piece of luggage. If a company has strong controls, it means we can confidently rely more on the metal detector and spend way less time doing manual bag searches.
Moving right along to Section 2, the system's inevitable limitations.
Because, let's face it, no metal detector is completely perfect, right? And neither is any internal control system. You could design the most beautiful, theoretically flawless control framework in the world, and it can still spectacularly fail. Why? Because of people. The syllabus highlights several inevitable limitations here. You've got basic human error, someone is just tired and makes a typo. Then there are ineffective controls that sound great on paper but simply don't work in practice. But honestly, the most dangerous limitations are the deliberate ones. Collusion, where two staff members secretly team up to bypass segregation of duties, and management override, where the boss basically abuses their power to force a fraudulent journal entry through.
Which brings us to Section 3, Ascertaining and Documenting Systems. Knowing those very real limitations, we obviously can't just nod and take the client's word that their systems are rock solid. We have to roll up our sleeves and find out for ourselves. If we want to rely on their controls, there are 4 steps we follow. First, we ascertain how the system supposedly operates. We do this by actively observing operations, reading their procedure manuals, or doing a walkthrough test where we trace one transaction from start to finish. And here is a huge red flag to remember. Inquiry alone, literally just asking the client questions, is never, ever sufficient audit evidence. So after we ascertain, step 2 is we document the system, step 3 we assess if its design is actually effective, and step 4 we test its real-world operation.
When it comes to that second step, documenting what you've found, you've basically got 3 main tools for your working papers. Narrative notes are just written descriptions. They are fantastic for simple, straightforward systems. But if it gets complicated, you want flowcharts. These diagrams are perfect for complex systems where you really need to visually trace the path of a document across different departments. And lastly, internal control questionnaires, or ICQs. These are prepared, standard lists of controls that you give to the client to answer yes or no to. Out there in the real world, auditors almost always use a combination of these three to build a really robust picture of the client's environment.
All right, on to Section 4, testing the controls.
So, if the system looks well designed on paper, we jump into testing. And here's where understanding the precise definition of a control is absolutely vital. Our source text lays it out clearly. A control is an activity applied in addition to the normal processing of the system. What does that mean? Well, simply typing up and raising a sales invoice is not a control. That's just normal, everyday business processing. The actual control is when the sales manager takes that generated invoice, checks the price against an officially authorized price list, and recalculates the math before it ever goes out the door. As auditors, we are testing that checking activity, not the standard processing activity.
So how do we actually test that checking activity? Well, we use a few key methods. We use observation, like literally standing in a warehouse, watching staff conduct an inventory count to see if they're doing it right. We use inspection, like physically grabbing a purchase order and looking for that manager's ink signature. For IT systems, we might run our own test data through their software. But perhaps the most powerful tool is reperformance. The text gives an awesome example of this. If a client claims they do monthly bank reconciliations, just looking at a signed piece of paper doesn't prove anything. The auditor has to sit down and actually reperform the entire reconciliation themselves to prove that the control genuinely caught any errors and isn't just a blind rubber stamp signature.
And finally, Section 5, Real-World Audit Application.
Let's drag all this theory out of the textbook and drop it right onto the client floor. Take a look at this specific scenario from the Murray Co. illustration in the syllabus. We're looking at a goods received note. Now, as an auditor testing controls, your job isn't just to verify that this piece of paper exists in a filing cabinet. You need to inspect it to see if the correct controls were actually applied. You check to see if the 75 kilograms of Vectrin they received actually matches the quantity they originally ordered. And crucially, you'd zone right in on the specific field that says quality of goods checked, yes. That little checkbox saying yes, that is your hard evidence of the control activity happening in real time.
Now flip the script. Let's look at a complete control failure. In the Bears World scenario, the text points out this little gem. One assistant maintains suppliers, orders inventory, and pays. The other receives orders and dispatches cuddly toys. Do you spot the huge red flag there? There is a massive, gaping hole in their segregation of duties. One single person controls the supplier list, decides what goods to order, and actually sends the cash out the door. That is basically a textbook invitation for fraud. They could so easily create a fake, ghost supplier, pay themselves every week, and the system would literally never catch it.
So, you find a glaring deficiency like that Bears World mess. What now? Well, you can't just walk away. You have to communicate this to management, usually formally through a management letter. But here's the kicker. You can't just complain about the problem. You have to provide actionable value. You need to clearly explain the potential consequence, in this case, massive risk of unauthorized payments or fraud, and then you give them a clear, practical recommendation, like highly recommending that the task of maintaining the supplier list is completely separated from the person who actually authorizes the payments. This, right here, is where a good auditor truly proves their worth to a business.
We've definitely covered a lot of ground today, from control objectives and substantive testing down to spotting catastrophic segregation of duty failures. But I want to leave you with one final thought as you close your books and head out into the field. If every single internal control system ultimately relies on humans at some level, and we all know humans are inherently flawed, can any system ever truly be 100% foolproof? The reality is, no, it can't. And honestly, that is exactly why the role of a sharp, professionally skeptical auditor remains absolutely indispensable. Keep your eyes open out there.